Hello, Alexander here. We're on chapter 15 of Accounting 202, or the second half of the original one. We're continuing on. This is investments and fair value accounting. So, the intro basically is before we learned about chapter 13, 14 was about stocks and bonds and how we issued them. So, we'd issue them. When you issue a stock, you're getting cash and then you're giving equity, or you're getting equity. And then when you issue a bond, you're getting cash and you're getting debt or liability. And so now this is about the other side of the whole spectrum, where you buy stocks as a company, you buy bonds, and you hold them to make money. So your cash would actually be credited, but then you're gaining now an asset. And so let's start with the intro. News Corporation. You invest cash to earn more cash. For example, you could deposit cash in a bank account to earn interest. You could also invest cash in a preferred or common stocks and in corporate or U.S. government notes and bonds. Preferred and common stock can be purchased through a stock exchange. I use E-Trade, but Scottrade, any of them are fine, such as the New York Stock Exchange. Preferred stock is purchased primarily with the exception of earning dividends. Common stock is purchased with the expectation of earning dividends or realizing gains from a price increase in the stock. Corporate and U.S. government bonds can also be purchased through a bond exchange. Bonds are purchased with the primary expectation of earning interest revenue. Companies make investments for many of the same reasons you would as an individual. For example, News Corporation, a diversified media company, which produces such popular TV shows as The Simpsons and American Idol, didn't know that, had invested $150 million of available cash in stocks and bonds. These investments are held by News Corporation for interest, dividends, and expected price increases. Unlike most individuals, however, companies also purchase significant amounts of outstanding common stock of other companies for strategic reasons. For example, News Corporation invested in 32% of Hulu, an online video joint company. They stream shows, very similar to Netflix, not the same. Investments in debt and equity securities give rise to a number of accounting issues, and that's what we're going to talk about now. So, a good example, one thing about stocks though, is it's almost always better to invest in an index fund if you're doing a buy and hold strategy. If you want gains for a good retirement account, I'd recommend a index fund. Hold it for 30 years, you get a 10% return a year or overall, and you'll be fine. That's the best. But in a business setting, buying another company's shares gives you a little bit of power over that company, or if you own a majority of their shares, you can influence them a little bit. So there's strategy to owning a certain company's shares as well. So why companies invest? They either invest in current operations, temporary investments, or long-term investments. And so current operations is basically they use it to pay the interest to creditors, dividends to stockholders, updating a factory, equipment, materials, expanding, purchasing more supplies, more inventory, and just more. If you have more expenses, you always have cash to hold. So investing in temporary investments can be debt or equity, so stocks or bonds. Usually they're held for a short amount of time. Stocks are usually held just to sell for a higher amount. Bonds are held, maybe they're shorter term bonds that give a higher interest, hopefully. Well, no, probably not. But just to make a little bit of interest, so your cash isn't just sitting. Or you can put it in a money market. And then long term is usually debt, or a large portion of stock of a company, probably 20 to 50%, and so that you would can influence them. So accounting for these is just the reverse of what we learned in the other chapters. Now, instead of getting cash, like let's say you purchase a bond, So you're not issuing a bond, you're purchasing. Got to get used to that language because the problems are gonna. That's the language is hardest to get used to. Story problems. So you buy, let's say, an $18,000 bond, but the interest is paid on the 31st of July and the 31st of January, but you purchased it on March 17th, which is 45 days after the interest payment. So what happens is you debit the investment U.S. Treasury bonds for the 18,000. That's the face value, and then you also have to debit. That's where it gets tricky, but then it's easy once you can do the math for it. Then you debit the interest receivable, which is $135 for 45 days of interest at 6%. And then you credit the cash for the 18,000 plus 135, 18,135, because you're paying whoever you bought that bond from, you have to pay them the interest they would have received those 45 days because you're buying it in between the interest payments. So that when you own it now, when you get the interest payment, you'll get the full interest payment. That's why you pay them the portion of interest payment they're not going to get, because you're going to get the full interest payment for the year. So it evens out. So you're just not just giving up extra money. And then when you make interest revenue, you debit the cash, of course, and credit interest revenue. And if you have any interest receivable that you recorded earlier, then you're going to credit that off, and that's going to be added to the revenue. And that cash should equal the whole interest payment. So you're just dividing up the credit between the interest revenue and receivable. And then, of course, at the end of the year, like this, the interest payments are January 31st, but the year ends, the fiscal year, of December 31st. So you have to, between July 31st and December 31st, you have to accrue that interest. And so here they did 18,000 times 6% times 5/12, which gives you 450. So you're going to debit interest receivable, credit interest revenue. This is where you're going to mess up on the homework, most likely. But don't worry, everybody does that. And so you're going to have to accrue the interest so you don't carry that interest into the next year and get them mixed up. Big thing of accounting, dates are huge. Keep interest in the same year that it's earned. And then, of course, on December 31st, then you're going to debit for the $540 for the full 6 month. But of course, you're going to credit the interest receivable for the $450 and debit interest revenue for the $90. And for bonds, when you sell a bond, you debit the cash for the whole amount you got, but then you credit the face value. So if you sold it less than 18,000, you're going to debit a loss on sale of investment. So now it's investments investments slash treasury or bond or stock or whatnot. Okay, and so stock. When you do stock, we're gonna do less than 20% ownership. So when you purchase less than 20% of a company, you debit investments, investment, whatever company, lease a company stock, Hasbro stock, credit cash for how much the whole dollar amount is, so 100,000, let's say. And so then when you get a dividend, you debit cash, credit dividend revenue for the dividend you received per share. So let's say 840 cents for the 2,000 that you bought. And then when you sell stock, debit the cash for the amount you have, take the investment of the stock off the books as a credit, and the difference is either a gain or a loss. So here it was a gain, 6,000. You sold it for more. Perfect. Now, if and that method is called the cost method. Now, if you buy between 20 to 50% of ownership of a company of stock, now that is the equity method. Now the equity method is you still debit the investments, but now it's called investments in lease a company stock or Hasbro stock. So there's no investments slash Hasbro, or now it's just investments in and then credit cash. And this here we purchased 40%. But the difference is you record the net income of the company stock that you have. So when they declare income of 105,000, we own 40%. We're going to debit our investment, and here is Flanders Corporation stock for $42,000, and credit income of Flanders Corporation. So we actually are claiming income because we own so much of that company that whatever income they get, we get a percentage on our books to represent our growth. And that's pretty neat. That's pretty nifty. So, and then dividends though are the opposite, where we get cash, but we actually, instead of getting dividend revenue, now we're going to credit investment in Flanders Corporation stock. So we're actually losing we're taking out of the investment to show that it's deflating the assets. Yeah, we're getting cash, but we're losing the assets, getting weaker instead of just a dividend. And then if you own more than 50% of a company, you purchase more than 50% of outstanding stock, you basically have consolidated financial statements, which we're not going to get into here. That's intermediate. It's a little bit more advanced. But basically, you now are a parent company, and they are now a subsidiary company. Kind of how I think Berkshire Hathaway owns 60% of Coca-Cola. They're a parent of Coca-Cola, if I'm not mistaken. But that's how it goes, where you own more than 50%. Now you're the parent. You basically have voting majority too. So you're going to be able to choose what they're going to have to do, voting wise. And of course, trading securities break down. There's two types of investments: trading, available for sale, and held to maturity securities. Trading securities, when the value goes up or down, we have something that's new. It's called valuation allowance for traded investments, and then we credit, that's what we debit, we credit unrealized gain on traded investments, or loss, if it's the other way around. And that just shows the fluctuation of the stock, the value. If it's a trading stock or security, we're basically going to have it, we're going to have the valuation on the balance sheet to either increase or decrease the asset. And then the unrealized gain or loss is going to show up on the income statement. Now, available for sale is different. We still have the valuation, but now the unrealized gain or loss is now on the equity. We don't actually put it on the income statement. Now it's on the equities section. A little bit different. And the held to maturity is basically going to be bonds or notes. You're going to hold it for the full 30 years, most likely. And so, it even talks about here in the book, Warren Buffett, Berkshire Hathaway, Coca-Cola, they own quite a bit of, so companies can own a lot of another company, basically get them to do what they need. And then financial analysis and interpretation, the dividend yield. Very great ratio to figure out. But the dividend yield equals dividends per share of common stock divided by market price per share of common stock. So you're basically dividing the dividend per share by the market price. So what the market's telling what the price is. So 12 cents divided by $15.50 equals 0.77% dividend yield. So that just shows, like Verizon here had a 6.57%. So that's pretty good. So that could be, so basically if your dividend is large and your market price is low, you're going to have a higher percent, which isn't necessarily a bad thing. Market price it's good to have a strong market price, but it's not everything. Dividends are just as good. Okay, so that was 15, and I'll do the problem. I'll probably do 4 small ones again. That seems to be the better route. I can always come back and do a large one if I have. I can always come back and do a bigger one. So thank you, and please like, subscribe, comment, ask questions if you must. Thank you so much, and I'll see you for the next one. We're almost done. Only 2 more chapters.